Hello and welcome to the Business Standard Morning Show. I'm Kanishka Gupta. It's the 30th of October 2023 and here are the questions we will be answering today. Is more pain in store for the Indian markets? Is it time to regulate social media for kids? Is convenience fee becoming too inconvenient? And what is the Keqiang index? Indian markets suffered their worst weekly sell-off since mid-September last week. Surging US Treasury yields and oil prices coupled with simmering tension in West Asia dragged benchmarks 2.5% lower in barely 4 sessions. But Friday came as a relief. So is this pullback rally a sign of trend reversal or is there more pain in store for the Indian markets? Nikita Vashisht and Rex Cano speak with experts to find out.
₹8.30 trillion. That's the wealth loss that investors suffered last week amid a troika of decadal high US bond yields, volatile crude oil prices, and seething war in West Asia. The frontline S&P BSE Sensex crashed 1,615 points in just 4 days to end below 64,000 levels. The NSE Nifty 50, meanwhile, settled near the 19,000 mark after breaching the psychological level briefly during the week. Among the broader indices, BSE Mid-Cap shed 2.4% and the Small Cap 3.4%. This sell-off was accentuated by foreign investors who have sold stock worth over 25,000 crore rupees thus far in October. This comes after selling worth over 47,000 crore rupees in the preceding 2 months. The question now on everyone's minds is if there is any respite in the near term.
The CBOE VIX, the index of volatility, is about 23 now, and therefore volatility will continue for some more time. Since the geopolitical situation is highly uncertain, it is difficult to say that the market has bottomed out, but it appears that the markets have been oversold.
Analysts fear the US Federal Reserve's lightly hawkish tone in the upcoming monetary policy could keep a lid on any pullback gains.
But they have not yet indicated to pivot anytime soon until the inflation numbers start cooling off. The US economy grew at the fastest pace in nearly 2 years, which continues to pose a risk for higher inflation to continue. So although the Fed might not hike interest rates in this upcoming fall policy meet, but markets would be keen to hear the commentary by Fed, which would provide more clarity on path ahead.
Technical chartists, too, see markets consolidating after the recent correction.
On chart-wise, we should expect some consolidation. Nifty 19,250 and 19,500 would play a very important resistance for near term. Whereas on the lower side, 18,750 and 18,500 would play some support. On the Sensex point, 63,000 round figure. This will be a support. Anything below that, we would see 62,300 on charts. And on the higher side, we would find some resistance in the range of 64,400 to 64,800.
Against this, what should be your trading strategy? According to VK Vijay Kumar of Geojit Financial Services, long-term investors may consider cherry-picking stocks from the banking and automobile space as valuations are turning fair. Clearly, uncertainty continues to close market sentiment with the US Fed policy, global cues, and India Inc.'s Q2 earnings being the key drivers. This week, nearly 500 companies are scheduled to report earnings, including Bharti Airtel, Larsen & Toubro, Hero MotoCorp, Sun Pharma, Tata Steel, Adani Enterprises, Tata Motors, Titan, and SBI.
While checking the stock prices, do you sometimes or often wander off and open your Instagram, Twitter, or Facebook account? Well, you're not alone. That feeling of restlessness and that anxiety of missing out on something crucial, it is increasingly gripping people. Kids too are hooked to it and are reportedly losing focus. In the United States, over 40 states have sued Facebook parent Meta for allegedly jeopardizing young minds. Kasturi Akil finds out if it is high time to regulate access to social media usage for children.
Over 30 states in the US have recently sued Meta, the parent company of Facebook and Instagram. The legal actions accuse Meta of deliberately incorporating features and tools that addict kids and teenagers to the application. The nature of the platform is such that it instills feelings of insecurity with respect to body image and other mental and physical health issues. Needless to say, the news has disappointed people across the globe and has once again sparked debates around the negligent handling of minors in a technology-driven society. A study conducted by the University of Michigan Health found out that more than 50% of the parents are worried about their child's mental health and social media usage. One wonders who should be blamed for overexposing children to social media. Is it the social media itself, the parents, or children?
Schools said don't bring mobiles to the school. This is a policy here in many schools, right? But then children are still smuggling. They find their way out to bring that telephone to school. So it is an illness, it is a disease, it is horrible to say whatever it is, but we are suffering because of it. God knows where it's going to take an end. Who is going to take responsibility? I don't think I, for one, have the answer. But I think even if we to be able to form one committee of parents and other social agents, I wonder if the people who are making a sale and good money out of these apps and these telephones, I think, will they realize their moral responsibility?
The US lawsuits also accused Meta of collecting personal information about users aged 13 and below who haven't provided parental consent to create an account on Facebook or Instagram. But is parental consent enough to shield children from harmful content? Over the years, different countries have rolled out different legislation to regulate social media access to kids. Last year, the US Congress floated a proposal of mandating online platforms to verify the age of the users by making them upload their government IDs to access the services. Google dismissed the proposal, arguing that such practice will prevent vulnerable teens from accessing helpful information. Last week, the long-awaited online safety bill in the UK became a law. Apart from age verification, the law entails controversial measures like messaging apps to examine encrypted messages to track potential child abuse content. Platforms like WhatsApp have opposed the law and threatened to leave the UK instead of compromising data privacy. Advertising firms have also raised concerns about the consequences of social media platforms implementing automated content filtering, which might inadvertently block positive and helpful advertising content. This raises the question, what is the right way to regulate, and how does one ensure that it doesn't impact business?
There are several mechanisms and ways to verify approximate age limit or approximate age of the user. Therefore, we could, through technology and through innovation, avoid use of verifiable consent or government issued ID cards and prevent this surveillance issue. We need a very healthy and important discussion between civil society, consumer groups, grassroots organizations who are working with children, who are working on mental health issues, who are working on children-related issues, who understand these problems, who are working with parents organizations, and these social media platforms and companies, so that they can sort of communicate and understand each other's point of view and can create some codes of practice and conduct.
Regulating social media could be tricky. Social media platforms are already subject to state laws and policies of their own. Further government interventions could lead to imposing intrusive controls and increased surveillance. Experts believe a potential solution lies in self-regulation. Tech companies could establish an industry coalition with representatives from all stakeholders. Such bodies could attempt to safeguard corporate profits and consumer interests simultaneously without government interventions.
The rise of social media and small screen entertainment has dealt a big blow to movie theatres too. Single screen halls, which used to dot the city landscape, have almost disappeared. And not all can afford to watch movies in multiplexes, thanks to costly tickets. Even well-heeled too complain about several additional charges. One of them is convenience fees. Several other platforms too are charging it, which is at times as high as 20%. So is someone looking out there? What are the regulations around it? Tariq Ahmed brings you the answers.
When we book a train, bus, or a movie ticket through online mode, the service providers charge us with an additional fee called convenience fee or internet handling fee. It can be as high as 20% at times. Like in the case of booking an online movie ticket on Book My Show, you end up paying a convenience fee that is about 8% of the total value of the ticket. A recent survey conducted by the Local Circles, a community social media platform, shows that 75% of the respondents were not happy with the convenience fee, against 15% who found it convenient for not having to stand in a queue. When asked if the government and PSUs should not charge the convenience fee, 93% responded yes. For the question how much the convenience fee should be, 63% said that it should be defined as an absolute value with a maximum of 50 rupees. 30% wanted to cap it at 0.5% of the transactional value. But what is the existing regulatory mechanism around the convenience fee in India?
There is a dichotomy here and a bit of a regulatory flux because while the IT Act does have a provision that allows service providers or people that provide services via the internet to charge a certain fee. But there is not any indication as to what is the percentage of that fee or on what transactions that would be applicable. The only provision there is that the service providers, online service providers, can charge a fee. So that's the justification that's used by most of these people to charge a fee. But at the same time, RBI has repeatedly frowned on this, and in fact, they brought in a notification in 2017, and then again subsequently in 2019, where they actually try to dissuade this practice.
All the airlines charge a non-refundable convenience fee for booking flights. Indigo charges 350 rupees for the domestic passenger and 550 for the international passenger. IRCTC charges a 30 rupees convenience fee for booking AC tickets through internet banking or credit or debit card transactions. Through the non-refundable convenience fee, Railway has earned over 600 crore rupees in the financial year 2022-23. For the platforms like Book My Show, PVR and Inox, the convenience fee is a major source of revenue. In 2019, Hyderabad-based Forum Against Corruption moved to consumer court against Book My Show, PVR and Ministry of Information and Technology's IT department for overcharging customers. Though a notification came prohibiting the convenience fee at Book My Show, later it resumed charging convenience after a court order gave a stay to the notification. But why do online booking platforms charge the convenience fee? On credit and debit card transactions, the payment processing companies like MasterCard and Visa charge the merchants. For debit cards, this amount is between 0.75% and 1%, and for credit cards, it is usually 1.5% to 3.5% of the transactional value. For the UPI transactions, the convenience fee is currently free in India. But most of the time, regardless of the payment methods, the online booking platforms charge the fee alike from all the customers.
Convenience fee, on the other hand, right, it is very similar, which is saying that, look, if I am sitting at home and making a digital transaction of buying a ticket rather than going and standing in line, right, then by charging a convenience fee, you are discouraging me to do that. Instead, you want me to go stand in a line where now you're going to have individuals, you're going to have air conditioning, real estate, all of that to sell that ticket to the consumer. So theoretically, there should be no convenience fee, absolutely zero. But convenience fee has sort of become a business model for some of the companies. And I think that is what we are basically saying should be better regulated and better disclosed. If they have to charge, for whatever reason, then it should be disclosed upfront and it should be kept at a very minimum amount, right? Like for instance, for IRCTC tickets, it's been defined as 35 rupees for air-conditioned tickets and 20 rupees for non-air conditioned tickets, right? So I think it's that kind of a definition needs to be there, or you can call as guidelines that need to be there for convenience fee, rather than, on a 7,000 rupee transaction charging 800 rupees as convenience fee. It is just outrageous.
Clearly, there is a case for capping the convenience fee. Experts say that keeping the convenience fee reasonable for the customer and standardizing it is necessary.
He's making plans for an early retirement. Business Standard.
China, on the other hand, has proposed to limit children's smartphone time to a maximum of 2 hours a day. In 2019, it has restricted children's daily online game time to 90 minutes. Moving on, the country lost a key political figure last week. Former Premier of China, Keqiang, died of a heart attack. He was also a prominent economist whose mistrust of official GDP numbers gave birth to an economic indicator. It was named after him. Raghav Agarwal has more on it.
When Hu Jintao's term ended in 2013, Li Keqiang was tipped to take over the reign of China, but Xi Jinping was favored and handed over the president's post. An economist who preferred private business, Li remained China's number 2 till a few days ago. He served as the 7th premier during the period. Like most Western economists, Li too didn't trust the economic data given by the Chinese government. In a WikiLeaks cable, Li was quoted as saying that China's gross domestic product numbers were man-made. He trusted 3 figures, which later came to be known as the Li Keqiang Index. The Li Keqiang Index is an economic measurement index created by The Economist in 2010 to measure China's economy. The 3 figures that were considered to form the index were taken from the leaked cable. Li was heard talking to an American diplomat that he focused on electricity consumption, rail cargo, and bank lending to ascertain the growth. These 3 figures are bundled into a single index known as the Li Keqiang Index, or simply Keqiang Index, to know about China's economy at a national level. Researchers from various institutions, including the Federal Reserve Bank of San Francisco, have tested the usefulness of the index. In 2017, a paper published by Columbia University showed that the best combination of the indicators gave 60% weight to loans, 30% to electricity, and 10% to rail cargo. Critics, however, argue that due to a falling focus on energy in China, the index is undermined. But many still prefer it due to the opacity of data from the Chinese government. For instance, a version of this index has its own ticker on Bloomberg. Just after the outbreak of the COVID-19 pandemic was reported, the Keqiang index plummeted. From 9.96 in December 2019, the index fell to 2.03 in February. It recovered till February 2021 when it was reported at 21.69. Since then, it has fallen to 6.53 in August.
I will achieve, I will fly high. I am the SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Interestingly, the Keqiang index also inspired a similar index in India. In 2015, financial advisors Ambit Capital came up with the Indian Keqiang Index, or IKI. It consists of 4 indicators, namely motor vehicle sales, capital goods imports, power demand and cargo handled at airports. Well, that's all for today. For more news and analysis, please log on to business-standard.com. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.